You probably know someone who can solve complex coding problems in their sleep, but still manages to completely wreck their bank account. Picture a 32-year-old software developer pulling down $150,000 a year. He builds flawless data systems all week. Then Friday hits and he throws $1,000 at a random options trade that expires the very next day. Meanwhile, his actual retirement account barely holds $2,000. It happens all the time. We see highly educated professionals making financial choices that make absolutely no sense on paper. You watch a brilliant doctor buy a terrible timeshare, or a sharp lawyer dump half their net worth into a meme coin right at the top. The brain power is obviously there, the income is definitely there, so why does the money management look like a total disaster? You start to wonder how someone with so much raw brain power can struggle so hard to just keep their cash safe. It turns out that a high IQ doesn't automatically protect your wallet. Bright people often set traps for themselves. When you get used to being the smartest person in the room, your mind takes shortcuts. You learn to trust quick patterns. You lean on your ability to outthink a problem. But the stock market doesn't care how high your SAT score was. Those exact mental shortcuts that help a bright person excel at their day job will actively drain their brokerage account. We all fall into mental traps, but sharp folks trip the hardest because their own logic convinces them they are right. They build a solid case for a bad move. You see this play out constantly when sharp people look for investment advice. Instead of doing the gritty research, they look up to someone powerful. They lock onto a big name. They assume a rich founder or a famous CEO holds all the answers to the complex market. Investors hand over their trust to famous leaders almost instantly. If a well-known billionaire tweets a vague opinion about a stock, thousands of smart people will buy that stock 5 minutes later. They don't read the balance sheet, they don't check the cash flow, they just see a verified check mark and a fancy title and they hit the buy button. You watch this happen every single week on Wall Street. People naturally want to follow the alpha voice in the room. If someone built a massive tech company, we assume they know exactly where the whole economy is heading next. It feels safe to ride their coattails. You figure a guy with a private jet probably knows something you don't. But trusting a big name blindly is a great way to lose your shirt. The market is full of experts who speak with total confidence right before their favorite sector crashes straight into the ground. Tech fans completely lost their minds back in December of 2024. Google stepped up to a microphone and revealed a new piece of hardware called the Willow chip. The numbers they shared sounded like pure science fiction. According to their own engineering blog, this new quantum chip ran a specific benchmark test in just 5 minutes. They claimed a regular supercomputer would need 10 septillion years to do that exact same math. That is a 10 with 24 zeros after it, a number so large it breaks your brain. The hype machine shifted into overdrive overnight. Smart engineers and tech workers read those blog posts and saw dollar signs. They looked at that impossible speed and decided the entire world was about to change by Tuesday. They assumed regular computers were instantly dead. The buzz spread through every investing forum and group chat like wildfire. Everyone wanted a piece of the quantum revolution before the opening bell rang. Traders dumped millions of dollars into any company with the word quantum in its name. Firms like Rigetti Computing and IonQ watched their share prices explode in a matter of days. You could pull up the charts and see the vertical green lines. Rigetti sat quietly between $1 and $2 for months. Nobody cared about it. Then the Google news hit, and the stock shot up over 1,000% almost instantly. Smart money chased the trend hard. Wall Street analysts started updating their price targets to keep up with the frenzy. People genuinely thought they were buying into the next version of the internet. The fear of missing out grabbed hold of seasoned professionals who should have known better. They saw the giant wave forming and jumped right in without checking the water depth. The entire sector rode the coattails of that single Google blog post straight to the moon. Traders faced a brutal reality exactly 1 month later. Jensen Huang walked onto a stage at an NVIDIA conference. As the CEO of the hottest AI chip maker on the planet, his words carry heavy weight. He took the microphone and calmly told the crowd that real quantum computing is still 15 to 30 years away. The reaction was brutal and fast. Traders heard the king of computer chips wave off the new technology, and they panicked. Shares of Rigetti and IonQ plunged 30% before the market even opened the next morning. The bloodbath continued through the trading day. People sold their shares as fast as they could smash the button on their phones. Those charts that looked like rocket ships suddenly looked like a cliff edge. And those stocks have struggled to crawl back up ever since. One speech wiped out billions of dollars in paper wealth in a matter of hours. None of those quantum companies actually changed their business models that week. Their research labs didn't catch on fire. Their patents didn't suddenly expire. The underlying math stayed exactly the same. The only thing that shifted was the voice in the room. Investors bought the hype because a massive giant like Google wrote a flashy blog post. Then they panic sold because the guy running Nvidia said to cool down. Smart buyers skipped the hard work of valuing the actual businesses. They let two tech giants do their thinking for them. They traded off the halo effect of famous names. You let someone with a big title guide your wallet, and you end up getting whipped back and forth by their passing thoughts. It's a dangerous game. Your financial future ends up chained to whatever a tech billionaire decides to say into a microphone on a Tuesday afternoon. People scrolling their phones see loud voices pushing bad ideas right now. You see famous names stepping totally outside their actual skill zone to hand out financial tips. A few months ago, Eric Trump posted to his millions of followers that it was a perfect time to buy Ethereum. A lot of smart people saw that famous last name and decided to follow the advice. They assumed a guy tied to a global real estate empire must know how crypto markets work. But the market sets its own rules. Since that specific post went live, the price of Ethereum has dropped by more than 45%. Half of that invested cash just vanished into thin air. A sharp investor might spot a trap like that easily. But when you are scrolling fast on your phone, a famous name creates a powerful illusion of safety. You forget to ask if the person talking actually knows anything about digital code. High achievers always look for the smartest person in the room to solve a problem. It feels like the most logical path. If your car breaks, you trust the best mechanic. If you get sick, you trust the top doctor, so you apply that exact same logic to money. You trust the loud billionaire. But investing operates in a totally different way. You have to actively fight your instinct to bow down to a fancy title. The best trick is to mentally blindfold yourself. Strip away the famous name from the advice. Imagine your local mail carrier gave you that exact same stock tip instead of a famous CEO. Picture your quirky neighbor yelling about that crypto coin over the fence. Does the idea still sound rock solid? If the advice only sounds good because a rich guy said it, you need to walk away. The math has to hold up entirely on its own. Smart investors actively hunt for people who disagree with them. If you feel ready to drop $5,000 on a shiny new tech stock, stop and find two smart critics who hate the company. Read the bearish reports. Dig into the negative articles. Force your brain to process the exact opposite argument. You need that friction to slow you down. It forces you to build real confidence in your own logic instead of just borrowing someone else's conviction. You start trusting your own rules. And once you learn to trust your own independent research, you might want to join the community here at Kyle Invests, where we break down these market traps every single week. Hitting that subscribe button costs you $0, but it connects you with people trying to strip the noise out of their portfolios. We just focus on clean numbers and clear thinking. You stop caring what the talking heads say on TV, and you start looking at the raw data right in front of you. You open up your feed and only read the articles that agree with you. We all do this. Your brain naturally hunts for data that proves you're right and ignores the red flags. Sharp, logical thinkers actually struggle the most with this trap. A really methodical person can build a bulletproof argument for a terrible financial move. Let's say a 40-year-old manager decides tech stocks will never go down. Suddenly, every news headline they notice is about a tech company beating earnings. They remember the guy at the gym who made money on Apple. They conveniently forget the coworker who lost their savings on a failed startup. They follow influencers who share their exact outlook. They build an echo chamber without even realizing it. The internet makes this incredibly easy. Social media algorithms track exactly how long you pause on a specific topic. If you linger on a post praising AI stocks, the system knows what to do next. It just feeds you more of the same story until you think the whole world agrees with you. Researchers at the University of Texas actually tracked how investors behave on online stock forums. They found that 85% of people only read posts matching what they already thought about a company. If someone wanted to buy a stock, about 78% of them only clicked on messages cheering for that exact trade. The sellers acted the same way. When an investor wanted to sell, roughly 60% of them only read threads backing up that choice. The wildest part of the study was how these traders judged the information. The investors claimed the posts agreeing with them were built on better facts. They thought those specific posts had stronger arguments and just made more sense. That wasn't actually true. Their brains just filtered the data to match their comfort zone. You see what you want to see. The numbers on the screen don't change, but your mind twists them to fit the story you already wrote. This blind spot costs traders a lot of money when a stock actually turns sour. You can break that echo chamber by interrogating your own motives. You just ask yourself, why 5 times in a row before buying anything? Let's run this test on a big company like Apple. You decide you want to buy their stock today. You ask the first why. Why do you want to own it? Maybe your answer is that they're the biggest tech brand around. Then you ask the second why. Why are they the biggest? You answer that everyone uses their phones and watches. You ask the third why. Why does that hardware matter to you? You say it creates a tough barrier for competitors to break through. You ask the fourth why. Why does that barrier matter? You answer that it keeps profits safe for years. Then you hit the fifth why. Why do you care more about safe profits than fast growth right now? That last question usually reveals a lot. You might realize you're actually scared of taking risks, or maybe you just want a stable place to park cash. Drilling down past the surface helps you spot the flaws in your own logic. You force yourself to face reality when you write down your choices. You just grab a notebook and document every time you make a big money move. Jot down exactly why you bought that asset, write out what you expect to happen, and put a timeline on it. Let's say you buy a new index fund on May 1st. You write down all your reasons for that specific date. Then you set a calendar reminder to check back in 30 days, or maybe 90 days. When you review those old notes, you get to see if your thought process actually matched real life. You see the gap between what you expected and what the market actually did. This habit strips away the fantasy. It becomes really hard to lie to yourself when your own handwriting from 6 months ago proves you were totally wrong about a trend. You learn to trust data over your own memory. Some professionals build up massive blind spots just by being really good at their jobs. This happens when you overestimate your own skills and start making wild predictions. A top-tier surgeon or a brilliant corporate lawyer spends years mastering a really hard field. They reach the top of their game. Their brain naturally assumes that winning at law means they'll easily win at investing, but the stock market doesn't care about your medical degree. The rules don't transfer over. You see, smart people ignore basic risks because they think they have a special edge. They look at a complicated market and assume they can outsmart it the same way they outsmart opposing counsel in a courtroom. They convince themselves that a specific financial bubble won't burst on them. They watch other people lose money and just think they're smarter than everyone else. That exact mindset destroyed fortunes during the dot-com crash. It happened again during the 2008 housing crisis, and you saw it recently with the 2022 crypto collapse. A lot of sharp folks also fall into the trap of tying up all their cash in one place. They might read a book about a famous billionaire and see a heavily concentrated portfolio. They try to copy that exact strategy with their own modest savings. This lack of variety gets really dangerous if you work for a massive corporation. Picture an engineer working at Apple. They spend 50 hours a week surrounded by the company culture. They test the new gadgets. They see the hype from the inside. They get paid in company shares and start feeling incredibly confident about the brand. Soon enough, 80% of their total net worth is tied up in that single stock ticker. Everything feels great while the tech sector booms. But if that specific company hits a rough patch or the whole sector pulls back, their financial life takes a huge hit. Their paycheck and their life savings are both locked into the exact same boat. Spreading your cash around protects you from your own blind loyalty. Wall Street actually saw the ultimate version of this trap back in 1998. A huge hedge fund called Long-Term Capital Management launched with a dream team of founders. We're talking about literal Nobel Prize winners in economics running the show. They built incredibly complex math models to beat the market using a massive amount of borrowed money. According to historical records, the fund performed incredibly well at first. They posted returns around 21% in year 1, year 2 hit 43%, and year 3 brought in 41%. The smartest guys in the room looked completely unstoppable. Then the world threw them a curveball. The 1997 Asian financial crisis rolled right into the 1998 Russian financial crisis. Those brilliant math models couldn't handle the chaos of human panic. The fund lost $4.6 billion in less than 4 months. The smartest guys on Wall Street collapsed under the weight of their own confidence. They thought their equations could predict the future perfectly. The market reminded them that nobody gets to hold a crystal ball. You have to give luck the respect it deserves. When an investor picks a winning stock, they love to praise their own genius. They tell their friends about the brilliant call they made, but a smart move requires looking at the board honestly. You need to ask how much of that win came from pure luck and random timing. Maybe the whole market just rallied that week. Maybe the Federal Reserve cut rates at the exact right second. You combat that ego by tracking your actual predictions over a long stretch. If you guess right 5 times but guess wrong 20 times, the math tells a clear story. You start to see that you might not be a market wizard after all. Acknowledging your own limits actually makes you a much safer investor in the long run. Keeping a tight record of your hits and misses grounds your expectations in reality. It forces you to respect the unpredictable nature of the market instead of relying on a false sense of control. A successful investor usually keeps their strategy incredibly boring. You don't need a complicated master plan to grow wealth. That's exactly why broad index funds stay so popular for long-term builders. They keep the process painfully simple. You buy a slice of the whole market and just sit on your hands for a few decades. The moment you catch yourself building a really complex defense for a weird trade, you should stop. If you have to draw a map to explain why a tiny mining stock is going to explode, your ego is probably taking the wheel. Real wealth building is rarely about finding the next massive trend before anyone else. It's mostly about sticking to basic rules and leaving the money alone. The market just rewards patience over time. Complex setups usually just mask a deep level of overconfidence. Sticking to the boring path removes the temptation to outsmart a system that is entirely out of your control. You might have a brilliant mind, but that doesn't give you a free pass on Wall Street. The market doesn't care where you went to college. It just grades your choices over a 30-year timeline. When you spot these mental traps early, you put yourself miles ahead of the pack. You stop trying to outsmart the system and start letting the math work for you quietly. You build wealth by stripping out the noise and focusing on the unglamorous basics. If you want to keep exploring how human behavior actually shapes our bank accounts, joining the community here at Kyle Invest takes just 1 click. We break down the real numbers every day without the hype. Stick to the boring plans, keep your ego in check, and let the market do the heavy lifting. You don't need to be the smartest person in the room to finish with the biggest account balance. You just need to be the most disciplined.